Okay, let's unpack this. We're doing a deep dive today on a figure who is maybe the most important bridge between Berkshire Hathaway's past and its future, Todd Combs.
He is such a crucial figure. And you're right, when you hear his name, it's usually with Ted Weschler, as one of Buffett's deputies. But that title today, it's wildly misleading.
Wildly, because he's not just managing a massive investment portfolio, he's also running one of the largest insurance companies on the planet.
Exactly, he's a hybrid. And our mission today is to really understand the career of this modernizer. How did he fundamentally change Berkshire's investments, bring in big tech, and pull off one of the biggest turnarounds in the firm's history?
We've got the full playbook on him. We've pulled together this really in-depth executive profile that details his secret sauce investment recipe, his whole philosophy. He calls it the last liberal art.
It's a fascinating narrative. It really is. It's about someone who learned to value risk with data, long before you learned to value stocks with financials.
Let's start at the very beginning, because his path to Omaha is so, well, it's not Wall Street. Not at all. He starts in regulation. A financial analyst for the state of Florida.
Yeah, the Banking, Securities, and Finance Division. And that gives him a completely different lens on the world.
How so?
It's about protecting the system, not exploiting it. It's a mindset focused on risk from day one. But the really critical job, the one that truly prepared him for Geico, came next. From 1996 to 2000, he was a pricing analyst at Progressive Insurance.
Oh, pricing analyst. That sounds super technical, very data heavy. What does that actually involve?
It's the core engine of the business. It is pure data science. They are focused on this highly quantitative work of matching rate with risk.
Matching rate with risk?
It means using these incredibly complex models to figure out, based on every possible data point, your age, your car, where you live, exactly what premium to charge so the company makes a profit but stays competitive. It's all about precise risk management. And that skill set, that is the core of who he is.
So he takes that data-driven focus, goes to Columbia, and then launches his own hedge fund, Castle Point Capital, in 2005. And his strategy was, wow, incredibly concentrated, almost exclusively financial firms.
And that concentration became his ultimate proving ground. Look, over 5 years, Castle Point had a cumulative return of 34%, which is fine, it's respectable.
But not what gets Buffett's attention.
Not at all. If you're Buffett or Munger, that number is almost irrelevant. Here's the number that mattered.
Yeah.
He specialized in the exact sector that blew up in 2008, financials. And during that absolute catastrophe, his fund reportedly lost only 5.7%.
Hold on, I have to pause there. He was all in on financials, and during the biggest crisis in that sector's history, he's down just 5.7%. That seems impossible. What was he doing differently?
It says everything about his focus on risk avoidance, not just maximizing upside. Our sources show he was specifically avoiding the big, heavily leveraged banks. Instead, he owned companies he called financial toll roads.
Financial toll roads. Can you break that down for us? What does that actually mean?
Sure. Think of it this way. A traditional bank, they take on risk, they build the highway, so to speak, and hope the cars pay back the loan for it.
Right.
A financial toll road, like MasterCard or CME Group, they don't take that lending risk. They just collect a small, stable fee, the toll, every single time a transaction happens. It's a capital-light, reliable moat. That's what he owned. And that discipline is what got him to Omaha.
And even that path was unorthodox. He didn't go through HR. He cold-called Charlie Munger. Met him first.
Yep. Munger was the filter. He basically pre-screened him and then gave him the ultimate seal of approval. He said, I really think Warren would like to meet you.
So he gets the all-day interview with Buffett. And Buffett immediately tests him right in his wheelhouse.
He does. He asks him if his old employer, Progressive, was better than Geico, the crown jewel of Berkshire's insurance empire.
That's the ultimate loyalty test.
It is. And Combs, drawing on his 4 years inside Progressive, gives this irreverent but totally authentic critique. He says Geico is better at marketing, sure, but Progressive is a data company, and data is going to win in the long run.
He's telling the boss his favorite company is behind the curve on the most important metric.
He is. And that candor, backed by real expertise, is what got him the job. As he said, most people just kiss your ass when they talk to Buffett. His honesty was exactly what they needed.
That's a huge lesson. Okay, before we dive into his investment philosophy, let's take a quick pause for some important information. To track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store. For our Chinese listeners, to Albafa Apple Store, Ashu, Albafa Indicator, Ewa, Ebososudo, Afa Apple Selega, Uchienda. Untinang, concept tapong, Kujijagen, de epoche to satsensed. Ujisabafa itaza avan. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
Okay, so let's get back to his framework. He calls it investing the last liberal art, which suggests it's not just about accounting, it's about history, psychology, science.
Right, but he boils this whole liberal art down to a really simple formula. It's a three-part multiplicative formula. Quality companies, excellent management, and reasonable prices. What's the key insight there? Why multiplicative?
That is the whole game. It's the difference between addition and multiplication, and it's a huge shift. If the elements were just additive, you could, buy a cheap company with bad managers and maybe it works out.
You could average it out.
You could try. But because it's multiplicative, he's saying if any one of those elements is a zero, say the management quality is non-existent, the entire investment loses all meaning. It just becomes zero.
That makes perfect sense. It's like baking a cake. If the quality of your flour is zero, it doesn't matter how great your oven is or how cheap the sugar was, the cake is still a zero.
Exactly. A perfect analogy. And he applies that same level of rigor to how he reads a company's financials. He insists on a specific order.
And the order is kind of counterintuitive. It's cash flow statement, then the balance sheet, and then last, the income statement. Why the income statement last?
Because, in his words, it's the most easily manipulated. It's full of non-cash estimates, accruals, accounting choices. The profit might not be real money. He starts with cash flow because that's the hardest to fake. Where's the actual cash going? Then the balance sheet for assets and liabilities. Only then does he look at the income statement, filtering its story through the hard facts he's already established.
This whole process is what he calls the inside-out approach. Start with the primary sources, the SEC filings, and build your understanding from the facts up. He specifically warns against going outside in.
This is a huge takeaway for listeners. Outside in is starting with a story you heard on TV, a narrative like StockX is a monopoly, and then looking for facts to support it. Combs argues that just creates confirmation bias. You have to start with the 10K, let the conclusion emerge from the data itself.
So when he and Buffett talk, which is all the time, it's like 95% qualitative discussion.
But it's a qualitative narrative built on a bedrock of hard verified data, not just opinions. And that brings us right to his impact on the portfolio.
Combs and Weschler were brought in to fix what the sources call Berkshire's errors of omission, especially in tech. Missing Google, missing Amazon.
They are the modernizing force. They were key in reframing Apple for Buffett. They argued successfully that it wasn't a tech hardware company. It was a consumer products business with a massive entrenched ecosystem, a giant moat. And they led the Amazon buy in 2019.
And we're still seeing them correct those old blind spots, the big 2024 stake in Alphabet in Google, which Buffett and Munger famously regretted missing. That was likely initiated by Combs or Weschler.
Absolutely. And his old financial toll roads idea has evolved too. He's applying that same moat concept to emerging market fintech. We see it with StoneCo in Brazil, Paytm in India. These are the new MasterCards, building that toll road model where traditional banking is still developing.
So his influence on the intellectual direction of Berkshire is it's undeniable. But here's the thing. His actual portfolio returns have apparently slightly trailed the S&P 500 over the last decade, which suggests his real value isn't just pure alpha, it's something else.
Absolutely. His true value lies in his operational expertise. And that brings us to the Geico's CEO role he took on in January 2020.
Yeah.
This is a major increase in responsibility.
And Geico, it was a crown jewel, but by 2022, it was in trouble. It posted a nearly $2 billion underwriting loss. A $2 billion loss. That's a serious wake-up call.
It was a crisis. But Combs came in and implemented the exact data analytics revolution he pitched to Buffett a decade ago. He wanted to fully bridge the company's analytics gap by 2025, upgrading their models, using telematics, data from the cars themselves, shifting from just mass advertising to hyper-targeted pricing.
And the results were, spectacular is the only word. Geico went from that $2 billion loss to a $7.8 billion profit in 2024. A stunning financial success.
But here's the central contradiction. Buffett's glowing public praise for Combs sits right next to the internal employee experience. Our sources say those efficiency gains were achieved through what's been described as brutal cuts.
Yeah, it wasn't the tap dance to work culture Buffett talks about. The headcount was almost cut in half, from around 48,000 to 27,000. And long-standing benefits like profit sharing were cut.
It tells you Combs is a tough, data-driven fixer. More like a private equity turnaround artist than the traditional hands-off Berkshire manager. He made hard, painful decisions to optimize the business.
And that qualitative insight, what he learned running Geico, sitting on the JP Morgan board, that is the ultimate inside-out advantage. He's not just reading the 10K, he has proprietary operator-level knowledge no one else has.
Which brings us to the future and a huge development. The original assumption was that Combs would become the chief investment officer, but the succession plan clarified that Greg Abel, the next CEO, would take control of investment decisions.
That threw a wrench in the whole narrative, so he's not the sole CIO successor anymore.
Correct. But his role is secure, and you could argue it's even more powerful as this hybrid investor-operator. His legacy is cemented. He is the modernizer. He provided that critical bridge to 21st century data, tech, and platforms. He fixed the founder's biggest blind spots.
So when we zoom out, what does Todd Combs teach us? His defining feature is that he's a compounding machine for ideas, for operational knowledge. That gives him a qualitative edge that no financial model can replicate.
And that leaves us with a final provocative thought for you to consider. If the greatest value investor today relies so heavily on this proprietary inside-out knowledge from actually running businesses, how much can purely quantitative investors truly achieve by only looking at public accounting data? Is running a business the new gold standard for deep dive due diligence? If you want to listen to our full deep dive about this topic or access more advanced contents, welcome to join our Deep Value Club membership or subscribe to us on Apple and Spotify Podcasts channel. Deep Value Investing. For our Chinese listeners, Deep Value Investing, do you know? Fu to see sandrans. You know, dutong deep sanduran na shuno. Deep Value Investing. Do you know ho he? Shul chan lu sekanu gea drom do ho he. Nuba hakadu dima. And iwa here bu anyu andua.